My daughter loves having me read books to her. In fact, she loves the same book read to her over and over and over again. And when we're in the car, she wants to hear the same song over and over and over and over again. And what she's really wanting, I only know this because I've read enough books on how the child brain or how the human brain gets developed. She's looking for that certainty. She wants to be certain on how that story ends or how that song ends. And I think we all kind of want certainty. Even when we grow up and we're in our 30s and our 40s and our 50s and our 60s and our 70s, we strive to have certainty about the future. Hey everybody, this is R.C. Peck with Fearless Wealth, and this week's theme, I'm going to call it certainty, but I'm going to tell you how we're going to talk about that certainty, and how we're going to talk about that is through the kind of the sub-scene of talking about the presidential cycle, why price charts, and 119 years of history. So the presidential cycle, in the U.S., a president's term is 4 years, and the third of the 4 years is the best for the stock market going back to 1965. So in a 4-year presidential cycle, 90% of a gain of that 4 years happens in the third year. And specifically, it happens in about 7 months. Now, the one thing you need to know, each year 3 actually starts in the previous year. So year 3, from a calendar point of view, starts this January 1st, 2015. But from a presidential cycle point of view, it starts October 1st. So in 4.5 months, year 3 of the presidential cycle is going to begin. And historically, over the last 49 years, that is the biggest 7 months of that 4-year period. So it's pretty significant. And there's only about a 5% chance of that third year being a down year. Now, this is pretty remarkable considering last year the stock market was up 32%, the year before was up 10%. Since the bottom in March of 2009, the stock market's up about 132%. I mean, this market is absolutely on fire. And it's absolutely moving up on the back of central bank manipulation and intervention. Like it or not, that's what's happening. So we have the presidential cycle coming up. Now, is it a near certainty that from October 1st, 2014 to April 30th, 2015, we're going to get a huge move up? No, but statistics say over the last half century, there's a good chance. So there's some certainty to that. Now, the next thing I want to show you, and I'm going to go a little bit of out of order, and that's only because I remember putting the price charts out of order, is what I want to talk about is 119 years of history. So now this goes a little bit against what I just said with the presidential cycle, which is presidential cycle is basically saying, hey, we're going to have a little bit more good times in front of us with the stock market. But now in this next piece of data, this next chart, which I'm titling 119 years of history, this is the U.S. stock market from 1896 to today. And basically what it's showing you is, in this first kind of big, thick column over here on the left, if the PE ratio of the stock market is between 20 and 21, and today it is between 20 and 21, the next 10 years, real returns, real, whenever you hear the word real, it means adjusted for inflation. The next 10-year real return is going to be an average of 3.4%. The point is we still have a lot of headwind in front of us. And when people are paying $20 or $21 for $1 of annual income, history, at least the last 119 years, says that's a lot of headwind in front of us, and we should not expect a lot of amazing things to happen. Now, the takeaway from these first two slides is I think the stock market's going to go higher. In fact, it might go, the S&P right now is around 1950-ish. We could see it go up 200, maybe even 300 more points, and then maybe crash 50%. So there's going to be volatility in our future. That is a certainty. But this is not the time to buy and forget. In a long-term secular bear market, which we are in, this PE ratio gets smaller and smaller. In the year 2000, it was 45. In the year 2007, it was 30. In the year 2014, right? About every 7 years. Now it's about 20. So it's gone from 45, 7 years later, to 30, 7 years later, to 20. So it is moving down. People are paying less and less for that $1 of income. History says this number will bottom somewhere below 12. So we have more volatility in front of us. That is a certainty. And the third thing I just want to show is about why price charts, why I talk about price charts so much. I don't have any like religious belief why price charts, but when I was growing up and when I was looking to understand what really works in investing, it kept the information, the breadcrumbs kept coming back to price. What is the price doing? What direction is the price moving? Because price gives us so much. Our emotions follow price. Our opinions follow price. The news follows price. Our accounts follow price. And so back on April 24th, not quite 3 months ago, I talked about Ukraine and Russia. And I had this price chart. And the price chart on the screen, this was the same one I had, was a price chart of the Russian stock market via the exchange traded fund RSX. And I said if this price, or if the Russian stock market index broke above this green line, that means there would be no civil war, there would be no war between Russia and Ukraine, and over time things would be getting better and better. But if it broke down below this blue line, guess I should have made that red, then that means things were getting worse, and in fact Ukraine might go into a civil war, or Ukraine and Russia might go into a war. Well, since then, this is what's happened. Back here was, right here, the 24th of April, and since then, the Russian stock market has gone up about 20%. And it broke above this. So regardless of what you hear on the news or on your Twitter feeds, the situation in Ukraine is getting better and not worse. Because the stock market, thousands, tens of thousands, hundreds of thousands of people's opinions are reflected in this price chart. And that's why price charts are so powerful, because it can tell us more about what's happening than a biased news source. So I want you to remember really, the point this week is that just recognize that we all want certainty. And because we want certainty, that's why price charts and knowing what history is, knowing what history has been with the markets and understanding that things in the stock market revert to their mean. The historic mean of the stock market is 15.5, a PE ratio of 15.5. That doesn't mean we bounce off 15.5 and go up. It means historically that's where it's been, which means we have to spend a little time below that. And these are some of the best tools that you can use, using price charts, understanding probability, knowing the history of the stock market and the history of humans' behavior in the stock market, and knowing that most things in the investment world revert to their mean. These are the best tools that can help you. So please take these tools and use these as just another way really to be fearless on your way to that secure and that free future. Until next week, I'm R.C. Peck.